Most Canadian seniors have never checked one document that can change the way they take retirement income. It is not a secret bank file. It is not an investment report. It is your Canada Pension Plan Statement of Contributions. And this document matters because it shows the record the government is using to estimate your CPP. It shows your pensionable earnings. It shows your CPP contributions. It can help you spot missing years, low years, mistakes, and the monthly amount you may receive if you start CPP now or later. Here is the part many people miss. CPP is not one flat payment that everyone gets at 65. Your amount depends on your work history, your contributions, your age when you start, and certain rules that may protect low-income years. And if you start CPP after 65, the monthly payment can rise by 0.7% for every month you wait, up to 42% more at age 70. That does not mean every senior should wait. If you need the money now, if your health is poor, if you have debt, or if you have no other income, starting earlier may be right. But the real mistake is this. Many Canadians make the decision without checking the document that tells them what their real numbers are. They guess. They listen to a neighbor. They assume Service Canada will automatically pick the best option. They think the CPP number is fixed. Then years later they realize they may have started too early, missed a correction, ignored a child-rearing rule, or failed to plan around OAS, GIS, tax, and work income. So in this video, I am going to walk you through this document, what to check, what mistakes can lower your income, and what to do before you apply. The document is called your CPP Statement of Contributions. In plain English, it is your official CPP record. It is the record of the earnings and CPP contributions tied to your social insurance number. This is important because CPP is based on your contributory history. That means the system looks at your years of work and contributions, then uses those records to calculate your benefit. This is federal. CPP is a federal public pension program for workers across Canada, except Quebec has the Quebec Pension Plan. If you lived and worked only in Quebec, or if your situation involves Quebec, you may need to check Retraite Quebec instead. Do not assume the CPP screen in My Service Canada account tells the full story for a Quebec work history. Now, why do seniors miss this document? Because nobody forces you to open it before you apply. Many people see CPP as something that just arrives at retirement. They know they paid into it, so they assume the government already has everything right. But even the official guidance says you should check the accuracy of your statement, including your name, date of birth, earnings, and contributions. That matters because one wrong year may not look dramatic on paper, but it can affect your estimate. A missing T4 year, an incorrect earnings amount, a self-employment reporting issue, or a period that should be protected under a special rule can all change the picture. So here is your first action step. Before you apply for CPP, sign in to My Service Canada account and open the Canada Pension Plan section. Look for View My Contributions and View My Benefit Estimates. If you do not use the internet, ask Service Canada for a paper copy. The important part is that you check it before making a long-term pension decision. Now let us talk about the 40% part, because this is where people get confused. The standard CPP age is 65. You can start as early as 60 or as late as 70. If you start before 65, your payment is reduced. If you start after 65, your payment increases by 0.7% per month. That is 8.4% per year. If you wait all the way to 70, that is up to 42% higher than the age 65 amount. Again, this is not free money for everyone. It is a trade-off. You receive fewer checks at the beginning, but each check is larger for life once it starts. If you live a long life, delaying may help. If you need income immediately, delaying may not work. This is exactly why you check the statement first. Do not make the decision from fear. Make it from numbers. Look at your estimated CPP at 65. Then look at what delaying may do. Ask yourself, can I cover basic costs until then? Do I have savings? Work income, a pension, RRIF income, or a spouse's income? How is my health? This is not only about the biggest CPP check. It is about your whole retirement cash flow. The second thing to check is missing years. Go through the record year by year. Compare it with your old T4 slips if you still have them. Look for years where you know you worked, but the CPP earnings look too low or missing. This is especially important if you changed employers often, worked seasonal jobs, had a small business, or were self-employed. If something looks wrong, do not ignore it. Contact Canada Pension Plan through Service Canada. If you were employed, you may need T4 slips, or a letter from the employer confirming earnings and CPP contributions. If you were self-employed, you may need tax returns and notices of assessment. If an old error affects your CPP record, it is worth asking. The third thing to check is low income years. Not every low year hurts you the same way. CPP has rules that can drop out some low earnings years from the calculation. In plain English, that means certain weak years may be left out, so they do not pull down your benefit as much. There are also rules connected to child rearing and disability periods. This is where many seniors miss money without realizing it. A person may look at their work record and think, I had several low years, so my CPP will just be low. But some low years may be treated differently. If you were the primary caregiver for young children and had little or no earnings during that time, the child rearing provision may help protect your CPP amount. That rule does not help every person, but it is important enough that you should ask before you accept a low estimate as final. This is especially important for couples. Sometimes one spouse handled more paid work, while the other stayed home with children, worked part-time, or had interrupted work. That person may assume their CPP is simply small and nothing can be done. Maybe that is true, but maybe there is a child-rearing provision or another record issue that has not been considered properly. The only way to know is to check. The fourth thing to check is whether you are still working after starting CPP. Many Canadians now work past 60 or 65. Some do it because they enjoy it. Some do it because bills are too high. Some work part-time for breathing room. If you are working and receiving CPP, you need to understand the post-retirement benefit. In plain English, this is an extra lifetime monthly benefit that may be created when you keep working and contributing to CPP after you have already started your CPP retirement pension. If you are between 60 and 65 and working while receiving CPP, contributions are mandatory. From 65 to 70, you may have a choice. At 70, CPP contributions stop. This is one of those rules where one small form matters. If you are 65 to 70 already receiving CPP or QPP and still working, you may be able to choose to stop contributing by using CRA Form CPT 30. If you have an employer, you usually give a copy to your employer and send the original to CRA. If you have more than one employer, the choice has to be handled properly with each employer. Now be careful. Stopping contributions may increase your take-home pay today, but continuing contributions may build an extra lifetime benefit. The right choice depends on your age, earnings, health, cash needs, and how much value the extra benefit may give you. Do not treat Form CPT 30 like a quick trick. Treat it like a decision. Ask, am I paying CPP for a reason, or am I paying because nobody explained the choice? The fifth thing this document helps with is timing your CPP around OAS. OAS is different from CPP. CPP is based on contributions. OAS is based mainly on age, legal status, and years of residence in Canada after age 18. CPP and OAS are separate benefits. Starting one does not automatically mean you must start the other at the same time. OAS also has a delay rule. If you wait after 65 to start OAS, your OAS pension can increase by 0.6% per month, up to 36% at age 70. But bigger is not always better for every person. Some seniors should not delay OAS, especially if they need the money, may qualify for GIS, or have a shorter life expectancy. The point is not to delay everything. The point is to understand the choices before signing. This is where the CPP statement becomes part of a bigger retirement income plan. You look at CPP, you look at OAS, you look at GIS if your income is modest. You look at work income, RIF withdrawals, workplace pensions, and taxes. Then you decide what order makes sense. The sixth thing seniors miss is the GIS connection. GIS means Guaranteed Income Supplement. It is a monthly, tax-free payment for low-income seniors who receive OAS. This can be very important for seniors living mostly on public pensions. But GIS is income tested, which means the amount depends on income. It is also reviewed each year using your federal tax return. This is why the tax return may be the second document seniors must never ignore. Even if you owe no tax, filing your tax return can protect benefits. Service Canada says GIS is reviewed each year using your federal tax return, and seniors should file by the deadline to avoid payment disruption. Here is the mistake. A senior retires, income is low, and thinks, I do not owe tax, so I do not need to file. That can be expensive. Your tax return tells the system whether you still qualify for income-tested benefits. No return can mean delays, letters, stop payments, or extra stress. So if you take one thing from this video, take this. Your CPP statement helps you understand your pension record, and your tax return helps keep many benefits moving. One document helps you plan, the other helps prove your income. The seventh thing to check is whether your CPP estimate is being treated like a promise. Your estimate is useful, but it is still based on the information available at the time. If your record has missing earnings, future earnings, self-employment income, Quebec work, child rearing periods, or other details that are not properly reflected, the estimate can change. That is why you should not build your whole retirement plan from one number on one screen. Use the estimate as a starting point. Then check the details behind it. Ask Service Canada questions if something looks wrong. Compare your tax slips, save copies. Keep a folder with your CPP statement, OAS letters, tax notices of assessment, T4 slips, T4A slips, RRSP or RIF slips, and any Service Canada letters. This sounds boring, but boring paperwork can protect real money. Now let us put this into a simple checklist. Step 1. Get your CPP Statement of Contributions from My Service Canada account or request it by mail. Step 2. Check your name, date of birth, earnings, and contributions. Step 3. Compare the record with old T4 slips, tax returns, and notices of assessment if you have them. Step 4. Look for low years, missing years, child rearing years, disability periods, and years where you worked in Quebec. Step 5. Check your estimated CPP at different start ages. Do not focus only on age 65. Look at the effect of starting earlier or later. Step 6. If you are between 65 and 70 and working while receiving CPP, learn whether continuing CPP contributions or filing CPT 30 makes more sense for you. Step 7. Check OAS separately. It has its own rules, its own delay increase, and its own connection to GIS. Step 8. File your tax return every year, even if you owe nothing, especially if you receive or may qualify for GIS. Step 9. If you are married or common law, check both people's records, not just one. Step 10. Before you apply, ask Service Canada questions in writing or by phone, and keep notes of the date, the answer, and the name or reference number if provided. The big message is this. You do not have to become a pension expert. You just have to stop making retirement decisions blind. Most Canadian seniors worked for decades. They paid into the system year after year. They should not lose income because one record was wrong, one low year was misunderstood, one form was missed, or one timing choice was made too quickly. Your CPP Statement of Contributions is not exciting. It will not look dramatic when you open it, but it may show you the difference between guessing and knowing. It may show you whether waiting could raise your monthly CPP. It may show you whether your record needs correction. It may show you questions you should ask before locking in a decision for life. And if this video helps you do one thing this week, do this. Check the document before you claim the pension. If you already started CPP, still check it. If you are 60, check it now. If you are 64, check it before your 65th birthday. If you are 67 and still working, check it before deciding whether to keep contributing. If you are helping a spouse, parent, brother, sister, or neighbor, help them check it too. Because the most expensive retirement mistake is not always a bad investment. Sometimes it is a government document sitting unread while the person it belongs to makes one of the biggest income decisions of their life. Do not panic. Do not rush. Do not assume. Open the statement, check the record, ask the questions, and make the choice with your eyes open. That is how you protect your income. That is how you protect your independence. And that is how you make sure the system gives you what your years of work have actually earned.